Good morning and welcome to Morning Markets from True Potential. Today we wanted to focus in on the Federal Reserve in the US's meeting yesterday. As you'll appreciate, it's been a key part of the discussion over the course of the week from Chris, from Paul and from George as well. So what did we get from the meeting yesterday? We got some clarity on how the Federal Reserve were thinking about changing interest rates in the US, a very clear signal that March would be the first time we would see an increase in interest rates coming through in the US. Also, we got some information as to how they were thinking about the state of the economy and how that was influencing their decision. And there's some really sort of interesting comments that have come out as a result of that. And if we look at that, what did Chair Powell say last night? He talked about the remarkable progress that we've seen in the labour market, but also that inflation is maybe well above their goal. We know where their goal is, 2%. Cast our mind back a couple of weeks ago, we're closer to 7%, so maybe it's not just above their goal, there's quite a wide gap that needs to be managed there. And that really that backdrop is removing that need for the policy support that came in as a result of the pandemic. So seeing a real step change in that. And also important to note that from the board's thoughts, they think that the US has reached full employment as well. So two key characteristics met in terms of their direction of interest rate policy. But never being one to surprise, that was probably what the market was really expecting in terms of the statement and the set out of that. What actually, I think, really caused more volatility in the market was the press conference itself, where Chair Powell talked about these aspects, the decisions that they've been making, but also was probably more focused in on the fact of where inflation is today, that it might be causing a slight cause for concern, and as such did not rule out the possibility of increasing interest rates at each of the Federal Reserve's meetings this year. Now that would have could equate to 7 interest rate increases, the magnitude of which is typically thought of being 0.25%. That was above where market expectations had been and did cause that volatility that we saw both in the bond market and also in the equity market towards the end of the session in the US. So US equity markets had been pretty strong, bouncing back from some of the losses we'd seen earlier in the week, but really closed down following those comments. The other side to that is that Chair Powell is being humble and nimble, key words that he used as well last night, thinking about the challenges that's being presented from a monetary policy perspective and that inflation backdrop. The other thing just to touch on that feeds back into inflation is geopolitics. The news flow that we're all seeing around Russia and Ukraine is certainly having an impact on both sentiment, but also into certain areas of asset markets, primarily the energy markets, where we're seeing the oil price continuing to increase very close to $90 a barrel, taking us back to levels that we last saw in 2014. And that's important because it feeds all the way back to the start of the discussion today on inflation and how energy prices are feeding into that. So that is something from a geopolitical perspective that's influencing asset markets, influencing inflation, and really at the end of the day, influencing what you and I pay for our costs on a daily basis, be that petrol, be it food, etc. So a real key linkage there between various different asset markets. I'll leave it there for today, but please do join us again tomorrow.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.